studying your last two. I swim med when turned in. The staring out to mute. And can learn the pole that sunk he died.
This slide introduces the methodology that advisors can use during real client meetings. After learning about salary planning, dividend planning, tax credits, family considerations, RRSPs, child care expenses, and personalized tax strategies, the next question becomes, how do you actually apply all of this when sitting across the table from a client? The answer is shown in this framework. At the center of the slide, we see an advisor meeting with an owner-manager client. This image represents the starting point of every successful planning engagement. Before recommendations are made, before calculations are run, and before strategies are selected, the advisor must first understand the client. That is why the speech bubble in the center says, first gather information, then build the strategy. This simple statement summarizes the entire planning process. The quality of the recommendation depends on the quality of the information gathered. Let's look at the 6 categories surrounding the meeting table. The first category is business income. The advisor begins by understanding the corporation itself. How much income is being generated? What does cash flow look like? How profitable is the business? And what opportunities exist within the corporation? Without understanding the business, it is impossible to design an effective compensation strategy. The second category is personal income. The advisor must also understand the client's personal tax situation. What sources of income already exist? What tax bracket is the client in? And how will additional salary or dividends affect their overall tax position? The third category is family situation. This includes spouses, children, dependents, and other family considerations. As we've seen throughout previous scenarios, family circumstances often have a significant impact on planning decisions. Compensation planning is rarely just about the business owner. It is often about the entire family. The fourth category is tax credits. The advisor identifies available tax credits and other tax-saving opportunities. These may include disability credits, tuition credits, medical expense credits, caregiver credits, and other personal tax benefits. As we learned earlier, tax credits can significantly affect which compensation strategy creates the best outcome. The fifth category is goals and objectives. Every client has different priorities. Some are focused on reducing taxes. Others are focused on retirement planning. Some are preparing for a business transition. Others want to maximize current cash flow. Understanding these goals allows the advisor to align recommendations with what matters most to the client. The sixth category is retirement planning. Compensation decisions often affect future retirement outcomes. Salary may create CPP contributions and RRSP room. Dividend strategies may support different planning objectives. Understanding retirement goals ensures that today's decisions support tomorrow's financial security. Notice how all 6 categories connect back to the center. That visual is important. None of these factors should be analyzed in isolation. Professional advisors evaluate them together as part of one integrated planning process. This is what separates strategic planning from simple tax preparation. At the bottom of the slide, we see the key message. Great planning starts with great questions. Before giving advice, advisors should gather information. Before making recommendations, advisors should understand the complete picture. And before choosing a compensation strategy, advisors should evaluate how all of these factors interact with one another. The lesson from this slide is straightforward but powerful. The best recommendations do not come from assumptions. They come from asking the right questions, gathering the right information, and building a strategy that reflects the client's unique circumstances. That process begins with a structured client meeting framework, and that framework is the foundation of effective compensation planning. This slide shows the actual process professional advisors use to transform information into a compensation recommendation. One of the biggest mistakes in tax planning is jumping directly to a recommendation before completing a proper analysis. Experienced advisors know that great planning follows a process, and that process is exactly what we see here. Let's begin with step 1. Gather information. Everything starts with understanding the client. The advisor collects details about the business, personal income, family circumstances, retirement objectives, cash flow needs, and financial goals. This may seem simple, but it is one of the most important steps in the entire process. If the information is incomplete, the recommendation may be flawed. That is why the planning process always begins with data collection. Next comes step 2. Analyze income sources. The advisor evaluates where income is coming from and how it is currently taxed. This includes salary income, dividend income, and corporate earnings. Each type of income has different tax characteristics and different planning implications. Understanding those differences helps identify potential opportunities. Step 3 is reviewing tax credits and deductions. This is where the advisor looks for factors that may influence the final tax result. These may include disability tax credits, tuition credits, medical expenses, caregiver credits, RRSP contributions, child care expenses, and other deductions. As we've learned throughout previous sections, these items can significantly change the effectiveness of different compensation strategies. Now, we move to step 4, model compensation options. At this stage, the advisor develops different scenarios. One scenario may emphasize salary, another may emphasize dividends, a third may use a hybrid approach. The goal is not to assume which strategy is best. The goal is to test multiple options using the client's actual data. This is where professional planning begins to separate itself from simple rule of thumb advice. Step 5 is comparing after-tax results. This is where the numbers tell the story. The advisor compares total taxes, available credits, deductions, cash flow impacts, retirement implications, and overall after-tax income under each scenario. Notice the comparison shown on the slide. Different compensation methods can produce different outcomes. The objective is to identify the option that delivers the best overall result for the client. Only after completing all of this work do we reach step 6. Build the recommendation. Now the advisor can confidently present a personalized strategy, not because it sounded good, not because someone else used it, but because it was tested, analyzed, and supported by data. The recommendation includes both the strategy and the reasoning behind it. That allows the client to understand not only what to do, but why it makes sense. At the bottom of the slide, we see an important advisor insight. Never recommend before running the numbers. This is one of the most valuable lessons in compensation planning. Many tax strategies sound attractive in theory, but professional advisors verify their assumptions through analysis before making recommendations. This reduces mistakes and increases confidence in the final plan. Notice how each step connects to the next. The process is structured and intentional. Information leads to analysis. Analysis leads to modeling. Modeling leads to comparison. And comparison leads to recommendation. Every stage builds on the previous one. That structure is what makes professional planning reliable and repeatable. And that brings us to the key message at the bottom of the slide. Good planning follows a process, not a guess. The best compensation strategies are not created by shortcuts. They are created through careful information gathering, thoughtful analysis, and objective evaluation of multiple options. When advisors follow a consistent planning methodology, they deliver better recommendations, create stronger client confidence, and achieve better long-term outcomes. That is the real value of a professional compensation planning process. This slide brings together everything we have covered throughout the compensation planning methodology. It shows how professional advisors transform raw information into meaningful client advice. At the center of the slide, we see an advisor presenting a completed compensation plan to a client. This represents the final stage of the planning process. But notice something important. The recommendation is not where the process begins. The recommendation is where the process ends. Everything starts with gathering the right information. On the left side of the slide, we see the information gathering phase. The advisor collects details about business income, personal income, family circumstances, tax credits, retirement goals, and cash flow needs. Each of these factors provides a piece of the overall planning picture. Individually, they are important, but together, they create the foundation for a personalized recommendation. Without complete information, effective planning becomes impossible. That is why the checklist on the left side is so important. The more accurate the information, the more accurate the recommendation. Once the information has been gathered, it moves into the analysis stage. In the center of the slide, we see the analysis engine. This is where professional planning happens. The advisor begins by calculating taxes. Next, tax credits and deductions are applied. Then different compensation scenarios are modeled. Salary strategies are tested. Dividend strategies are tested. Hybrid approaches may also be evaluated. After that, the advisor compares the after-tax outcomes of each scenario. Not only today's results, but also long-term impacts and future planning objectives. This process transforms raw information into actionable insights. Notice the message above the analysis engine. The recommendation is only as good as the analysis behind it. This statement captures the essence of professional advice. A recommendation should never be based on assumptions. It should be based on careful evaluation, objective analysis, and measurable results. Now look at the right side of the slide. This is where the final recommendation takes shape. The advisor is no longer presenting a generic idea. The advisor is presenting a customized plan. The recommendation includes a salary strategy, a dividend strategy, estimated tax savings, retirement implications, family planning considerations, and a clear action plan for implementation. Each recommendation is specifically designed around the client's unique circumstances. This is what creates real value. Notice the comparison at the bottom of the slide. On the left, we see the average advisor. This approach relies on rules of thumb, standard assumptions, and one-size-fits-all recommendations. While simple, this approach often overlooks important planning opportunities. On the right, we see the professional advisor. The professional advisor uses complete client data, performs detailed analysis, models multiple scenarios, and delivers customized advice. The difference is significant. One approach provides generic recommendations. The other provides strategic recommendations based on evidence. The results section highlights the benefits of this methodology. Better client outcomes, higher confidence, personalized recommendations, greater advisor credibility, and stronger long-term planning. These benefits occur because the recommendation is supported by a structured process rather than intuition alone. Professional planning creates consistency, it creates clarity, and it creates confidence. Most importantly, it helps clients make better financial decisions. And that leads us to the final message at the bottom of the slide. Great advisors follow a repeatable planning methodology. The most successful advisors are not simply experts in tax rules. They are experts in process. They gather information systematically. They analyze data objectively. They evaluate multiple options. And they deliver recommendations tailored to the client's unique situation. That repeatable methodology is what transforms analysis into advice and advice into meaningful client outcomes. And that is the ultimate goal of professional compensation planning.